Welcome once again to our discussion on principles of economics. In today's lecture, we are going to talk about saving, investment, and financial system. Now, why we are discussing this saving, investment, and financial system? If you recall, in our previous lecture, we said that productivity is one of the major reasons for countries to have different level of income and thereby standard of living. And then we concluded our lecture by saying that saving and investment, they are one of the most important factors that can actually raise the productivity, because saving helps investment to happen, and when investment happens, that helps capital accumulation, capital formulation, and that capital formulation is basically mean that the countries will have more equipment, more machinery, and more human capital, so on and so forth. And when the average worker are getting more equipment to work with, more machinery to work with, when the laborers are having more human capital in the form of knowledge that comes through education and training, that also helps raising their productivity and thereby gaining more output. So therefore, saving and investment is so much important to have the country to have more capital. Now, one interesting feature about the saving and investment process is that saving and investment sometimes, or quite frequently I would say, are done by two different individuals. See, I am an individual, I don't want to invest my money in business, or I don't want to do business on my own by investing my money on plant and machinery or equipment or any other activities. Rather, I would be happy to save my money in banks and get some return after certain interval. While a company might be interested in doing business by spending money on capital, investing in capital, but the company doesn't have enough money. So that means the savers and investors, they should match, they should come forward and they should meet together. So the company who is doing the investment would like to have some loanable fund, some money, and that fund will come from the people who are saving their money, and they would like to give it to the investors. Now, how will they meet? In an economy, so I want to have my saving, I have money, but I don't know who requires my money in return of some interest. At the same time, you as a company manager, you would like to have some loanable fund, but you don't actually know who would be ready to give you the money. So then we require some kind of intermediaries that will help us the transaction or interaction between the savers and the investors to meet and actually to have this investment to happen. Loanable funds should flow from the savers to investors, and that is possible only through financial system, financial intermediaries. In absence of any financial system or intermediaries, there would be a huge transaction cost for the savers to identify who require funds so that they can give it to them and enjoy some kind of interest. At the same time, investors also need to identify who are the savers so that they can approach them and get their loanable fund in return of some extra payment in terms of rate of interest. So that is where the importance of financial system or financial intermediaries. They actually help facilitate this flow of funds from savers to investors, even though savers and investors, they themselves are not meeting in a place together. That is the beauty of the financial system that helps flowing fund from savers to investors smoothly and investment to happen in an economy. So, the financial system then consists of a group of institutions in the economy that help match, as I said, one person's savings with another person's investment. So, it moves economy's scarce resources from savers to the borrowers or the investors. Okay? So, financial system is nothing but a group of institutions. What are those financial institutions? The financial system actually made up of financial institutions that coordinate, as I said, the actions between savers and investors. And mainly there are two types of financial institution. One is financial market and another one is financial intermediaries. So let us see what are those financial market. Financial market, when you talk about, there are two types. One is called stock market, another one is called bond market. Now I will explain what is stock market and what is bond market. Stock market is basically when the company requires money. Suppose your friend has opened one organization and your friend requires some money to run the business. Now there are two ways by which your friend can raise money. Your friend can approach you that, can you please give me 1 lakh rupee and I will give you some kind of return in some kind of interest in return. So that is called debt financing. That means you have some debt from your friends. Alternatively, if you want the money from your friend, you can also offer this thing. If you give 1 lakh rupee, I will give you a share of my company, so that at the end of the day, if I make some profit, you will also enjoy a percentage of my profit. And that is exactly is called selling the equity or stock, right? So stock market is a market wherein you can actually buy and sell the company's share. That is why it is also known as share market. Okay, so I am sharing a portion of my profit. So when I am investing in a company's share or stock, that means I am buying a small fraction of company's ownership, right? So there is a risk involved. If the company makes profit, then you will get a share of it. If the company makes losses, then you are also a part of that loss. So that is what is called stock market, which helps the investors to get money from you, me and many others who are interested to put their money on stock market. There is also something called bond market. Now bond is like a certificate, and you buy a certificate and then there would be some terms and conditions written on the certificate. What is the face value of that bond? What is the price? Let us say I am buying a 10,000 rupees bond, a certificate basically. You might have heard about gold bond, this and that, which Reserve Bank of India sometimes they announces that they are going to introduce this type of bonds. That means a certificate you buy, there is a face value 10,000 rupees. After some 2 years, 3 years, 5 years, after maturity, you will get some 5% or 10% interest on that. That is called maturity. So these are the two market, either bond market and stock market. Usually stock market's return is more than the bond market, because you are associated with higher risk which is involved in the stock market. But bond market is mostly of some certain return. You don't have to bear the same amount of risk what you are incurring in stock market. Then there are financial intermediaries like banks, we all know what is a bank. Bank means we are depositing our money, and bank can use that money to somebody who wants loan. So bank will give you some rate of interest, let's say 10%, and bank will charge little extra to the borrowers, thereby banks make their own profit, right? So banks actually creates loanable fund. When I deposit my 1 lakh money in bank, bank will give me some 7% or 8% rate of interest yearly, and then banks give loan to borrowers at a little higher than what they are paying to me, right? So borrowing rate of interest is little higher than the lending. So that is how banks make profit. And there is something called mutual fund. Have you heard about mutual fund? What is mutual fund? Mutual fund is basically an institution wherein they take your money and then they invest on behalf of you on several bonds and stocks. The idea is, if I invest my entire money in one bond, then I am taking so much of risk, because a particular company may make profit or may make so much of loss also. So there is a huge risk involved when I am putting my entire saving in one particular company stock. Rather, what I can do, I can always diversify my risk by putting my money into different stocks. But I don't know who are the best companies to invest. Therefore, I give that responsibility to the mutual fund organizations. They do the investment on behalf of you and they charge you little money from you as a brokerage fees. That is the idea of mutual fund. So people with better knowledge about the stock market, they work as an agent for you. You are basically giving the responsibility to those agents working in mutual funds to manage your fund efficiently so that your risk is diversified. Of course, you can easily understand, instead of putting my entire money in one company, if I put in 10 companies, then there is a probability that at least some companies will make profit, right? And but the idea is, I don't know what are the companies which are going to make profit, because it requires some amount of time to invest to understand who are the best companies, who are the bad companies, so that I can make a better utilization of fund. And that job is done by the people who are the specialists working in the mutual fund organizations. They will manage your fund. That is the idea. These are the two financial intermediaries, banks and mutual funds. Then financial markets are basically the institutions through which savers can directly provide funds to the borrowers. What is happening? When I am investing my money on stock market, let's say I am investing in Reliance stock. So that means I am directly sharing my fund to Reliance. There is no intermediary coming in between. I will simply buy one stock of the Reliance company, or let's say Aditya Birla. So then what I am doing here, I am directly providing my funds to the borrowers. There is no middleman here. But financial intermediaries are that banks are mutual funds. In that case, I am not directly interacting with the borrowers. Rather, I am giving the money to the banks or to the mutual fund, and then bank is giving the money to the borrower. Okay. So there is no direct interaction happening here. Interaction is happening through the intermediaries, let's say banks and mutual funds. And there is financial, when you talk about financial market, as I said, that there are two, one is called stock market, another one is called bond market. What is a bond? I have already explained that bond is basically a certificate of indebtedness. That is a proof. Otherwise, anyone can deny, no, I have not taken any money from you. So that means that is a certificate of indebtedness, that yes, I have taken your money and I have the obligations that I will repay your money back with the term after how many months or year, that is the length, that is called term, okay, 2 years, 5 years, and at the end of the term only the bond is going to be mature. Then there is credit risk, the probability that the borrower will fail to pay some of the interest or even principal. It doesn't happen quite frequently in terms of bond, but there is, of course, there is some amount of risk, that is called credit risk. And the tax treatment, when I earn interest out of that bond, do I need to pay tax out of that? So, what is the tax law that is applicable to the interest earned through that bond? So, these are the three things mentioned in the certificate. What is the time of maturity? That is called length of the time until the bond matures, credit risk and tax treatment. These three things are mentioned in that certificate, that is called bond. Okay. And in stock market, stock represents a claim or a partial ownership. As I said, your friend might be saying that if you give me 1 lakh rupee, I will share a percentage of ownership of my company with you. Okay. Therefore, you can claim a profit if I make, at the same time you will be part of my loss as well. And the sale of stock raises money, which is called equity financing. So, one way you can go by debt financing, means directly borrowing money, you will pay interest. Another way is equity financing, right. The most important stock exchanges in India are Bombay Stock Exchange, which is known as BSE, and then National Stock Exchange, which is NSE. And in the United States, they are called New York Stock Exchange, American Stock Exchange, and NASDAQ. So, these are the important stock exchanges in India and in the US. So, you should understand the difference between debt financing and equity financing. Debt financing means I am borrowing money saying that I will pay you some return. Less risk is involved in debt financing, return is also less, only 5 to 6% or 7%. But when I am going for equity financing, I am selling ownership. If you buy couple of shares from my company and if my company makes huge profit, then you are also going to get huge profit out of that. But if I make loss, then you are also going to part of that loss. So, there is risk involved. Since you are taking a part of risk, return is also higher. Higher the risk, higher would be the return. That is very simple. Okay. So, in most newspapers, stock tables, they provide the following information. If you look at the newspaper stock market, what is the price of a share, what is the volume number of shares sold for a particular company. So, what is the dividend? It is called dividend. The profit paid to the shareholder or stockholders, they are called dividend. Then price earning ratio, that is very important. What is the price of a particular stock and what is the earning that is coming out of that stock. Higher price earning ratio means that is not a good stock, because the price is so much, but earning is not that great. Okay. So, P by E ratio talks about the health of financial health or performance of the company also. One particular stock, how much is the price and how much is the earning that the stock is going to generate. So, price earning ratio, lower the price earning ratio means price is low but earning is very good, that means the company is making very good profit. So, that is why price to earning ratio is very important. So, financial intermediaries are basically, as I said, financial institutions through which savers can indirectly provide funds to the borrowers. Here direct interaction is not happening, unlike the financial institution like banks and stock market. So this is called financial intermediaries. In financial market, direct interaction. I am buying the share of Reliance company means I am directly providing my fund to Reliance. But here it is through the financial institution. So financial intermediaries are banks. They take deposits from people who want to save and use the deposits to make loans to people who want to borrow, and pay depositors interest on their deposit and charge borrowers slightly higher interest on their loans. That is how bank makes profit, right? So when I put my money, bank is giving me 5%, but when you approach the bank for borrowing, bank will charge, let's say, 7%. So that 2% is the bank's profit. That is how bank will make profit out of this business. So banks basically help create a medium of exchange by allowing people to write checks against their deposit. So it's a medium of exchange. So I deposit all my saving into bank, then bank will give me some check. I can write a check to you and you can go and use that check and get the money. So bank is facilitating that medium of exchange, right? And it facilitates the purchase of goods and services as well. And as I said, mutual fund is basically an institution that sells shares to the public and use that proceeds to buy a portfolio. Portfolio means it's kind of a basket wherein you have shares of different companies. Okay, in a basket you have a share of different companies. That is why this is called portfolio. Share, it can consist of some amount of bond also. So mutual fund allow people with small amounts of money to easily diversify. Suppose I am a small investor, I have only 50,000. So with 50,000 it is difficult to buy company share. But if you put in mutual fund, since there are thousands of people who are putting their money in mutual fund, using all of your money, all the people who are putting their money in mutual fund, they will buy shares. With your own money, 50,000 or even 10,000 rupees, you may not be individually able to buy a company share. But when hundreds of people they are putting their money in mutual fund, the mutual fund would be able to buy shares using that money, and they will give you a return with your portfolio. So there are other financial institutions like credit union. Credit union is kind of cooperative. Okay, when some people they come together and build some kind of cooperative, so that if any members of the cooperative requires any loan, he or she can easily get it from the cooperative. It is kind of non-profit organization. Okay, you might have come across this type of financial cooperatives made by certain members. Only members have access to that credit union, that is called cooperative. So members can easily go and take loans from there. Then you have pension funds, insurance companies are also there. Okay, you can buy health insurance, you can buy life insurance. These are also financial intermediaries. Then loan sharks, that is very important. Loan shark is, do you know what is, I hope you know what is shark. Shark is somebody, shark means they will eat you entire body without giving any pain. That is very dangerous actually. These people are money lenders without any license, and they charge exorbitantly higher amount of interest. Those people are there in informal markets. Some people, poor people, they don't have enough collateral to approach to the bank. If these people go to the bank and ask for some 1 lakh loan, bank will not give loan to everyone. Bank will ask, okay, you want loan, so what is your income, what is your property, so on and so forth. So bank is not going to give loans to anyone and everyone. Then what is the alternative for these poor people? They will go to these money lenders who will give you loan, but they will charge exorbitantly higher level of interest. If the banking interest rate is 7%, sometimes they may charge 20%. You may have no options because you need money urgently. Let's say for your daughter's marriage, let's say for buying a property, or let's say for some treatment purpose. Then you approach to this loan sharks, who are people without any license to involve themselves in this business, and they charge exorbitantly higher level of price. This is called informal credit market. Formal credit markets are these: credit union, banks, pension funds, insurance companies. This is informal credit markets where these loan sharks they exist. So then saving investment in the national income account, this is now a macro perspective that will give you at the country level who is saving, who is borrowing, and savers are of two types. There is something called public saving, there is something called private saving, and entire things taken together, this is called national saving. So I will talk about this national saving in our next class. Thank you.